Hello learners, in the past two video lessons, we have learnt about calculation of specific cost of capital. That means we had learnt about the calculation of cost of debenture, cost of preference share capital and cost of equity share capital, and lastly we learnt about cost of retained earning also. So those all were the specific cost of capital. As you know, capital structure of a company will never comprise of one single source of capital. It will be generally a blend of different sources of capital. In general, we have two kinds of capital structures: levered capital structure and unlevered capital structure. By unlevered capital structure, I mean a capital structure in which company has not used debentures and preference shares. The only funding source is equity shareholders funds, that is paid up capital as well as retained earning. Such kind of firm is unlevered firm or unleveraged firm, whereas another kind of firm might be there, leveraged firm, in which company is using a mix of the different sources, that is along with the owner's funds they are using borrowed funds also, or along with the equity share capital they are using preference share capital also. So such kind of capital structure is termed as leveraged capital structure, or such firm is levered firm. So those are the different kind of firms categorized on the basis of capital structure. Now, the moment company uses more than one kind of source of capital, we need to work out overall cost of capital or weighted average cost of capital. So let us learn today what is weighted average cost of capital. Weighted average cost of capital is the average cost of funds by weighing the cost of each specific type of capital by its proportion in the firm's capital structure. That means to say, if a company is using only two sources, let us assume equity share capital and the preference share capital. Now how do we calculate weighted average cost of capital for that company? In that case, we will be taking the proportion of equity funding as well as proportion of preference share capital funding and then multiplying that respective proportion with the specific cost to arrive at weighted average cost of capital. Now, question comes, what kind of weight has to be used? So it can be either book value weight, market value weight and marginal weights. So what are these weights? We will understand that also, and then we will proceed further with the calculation part. Book value weights. Now, a kind of calculation in which basic premises are that we are weighing the different sources of capital by using their book value. As we know, book value means the value at which a particular capital is recorded in the balance sheet. That means, if suppose we take an example, a company issues 100 crore rupees par value shares in the market at a price of 200 crore. But in the books of accounts of the company, par value will be recorded as 100 crore. So when we say book value, it means we are referring to the par value of respective source. Whereas, in contrast to the book value, we can have market value also. That means, in that scenario, we will be weighing the different sources of capital by using their respective market value. So book value is not considered at that point of time, rather market value will be considered. Similarly, marginal weights. So when to take marginal weights? The moment company is going to raise further capital, then we will be using the marginal weights. Take an example. Suppose existing capital structure of a company is equity 100 crore and debt 50 crore. So in the existing capital structure, so these are the book values I have taken. So proportion of equity in the total 150 crore is 2/3, whereas proportion of debt is 1/3. So that is basically book value weight. If now we say, apart from the existing one, company has more need of the funds and now they will be going in for the new equity. So new equity will be, let us say 80 crore, and new debt, that means company is planning to raise further 100 crore rupees. In that, new equity will be 80 crores and new debt will be 20 crores. Now when we have to calculate cost of this particular chunk of the money or chunk of the funds, then proportion of equity in the marginal weight will be, it will be 4 upon 5, that is 80%. Because out of the further issue of 100 crore, 80% comes from the equity. So in the marginal weights, 80% will go towards equity and 20% will go towards debt. So that will be, specifically we will be calculating weighted average cost of this 100 crore. That will be called as marginal cost of capital. So marginal weights will be applied whenever company will be going in for the further issue. So that is the mechanism to select the weights for calculating weighted average cost of capital. Now, if we understand how to calculate it, so this example will help us in calculating that. So let us first read this example, and this example is about using book value weights. A firm's cost of capital of the specific sources is as follows. So cost of debt before tax 10%, cost of preference shares 14%, cost of equity 17%. Now always remember, while calculating weighted average cost of capital, we use after tax cost of specific sources. What we use? We use after tax cost. Now pay the attention. What is given to us? Cost of debt is before tax. By default, cost of preference is always after tax, and by default, cost of equity is after tax. The reason being, on equity and preference, company is paying the dividend, and dividend is paid out of the after tax income. So therefore, without any glitch, cost of these two sources is always after tax. Whether it is given in the question or not, so default consideration for cost of preference and cost of equity is after tax. Whereas for cost of debt, we have been provided that it is before tax. So first of all, convert this before tax cost into KD post tax, that is after tax. So it will be KD pre-tax multiplied with 1 minus TC. So my pre-tax KD is 10%. Tax rate given to us is 30% to be plugged in as 0.30. So what we get? 10 multiplied with 0.7, that makes it 7%. So we can say after tax cost of debt is 7%. Now while calculating weighted average cost of capital, whatever may be the weight mechanism, either book value weight, market value weight or marginal weights, always use after tax cost of specific sources. So that was the understanding of the specific cost. Now we see what is the capital structure of a company. By capital structure of a company, we mean composition of different long-term sources of funds used by the company to fund its assets. So in this case, capital structure comprises of debt, book value 3 lakhs, preference share capital, book value 2 lakhs, equity 5 lakhs, total becomes 10 lakhs. Now we have to calculate weighted average cost of capital. So you have to remember 10%, 14% and 17%. So let us proceed in the next slide to show the calculation. So that is where we can see. So this kind of table you can prepare. Debt was 3 lakhs. So how do we get the proportion? That means in the total capital structure, what is the proportion of debt? What is the proportion of debt? It is simple. Out of the total 10 lakh, debt is 3 lakhs. So 3 lakh divided by 10, we will get 0.3. Similarly, for preference, 2 lakh divided by 10. 10 is this one, total sum of the capital. And then equity is 5 lakh out of 10. So it becomes 0.5. And sum of the weights should be 1. So if suppose due to approximation sum does not come to 1, you can round off the figures or approximate the figures. So first step is, while assigning the weights, calculate proportion of each source of capital. Then we will take cost, and this has to be post tax, after tax cost. So if you remember, we had 7% cost of debt, 14% of preference, and 17% of equity. Now that is the fourth column we have created. Now fifth column, as you can see, multiply third column and the fourth column. So 0.3 will be multiplied with 7. Why we are multiplying 0.3 with the 7? Because proportion of debt in the capital structure is 30% and cost of debt is 7%. So we get it 2.1. Similarly, 0.2 will be multiplied with 14%, because 20% is the proportion of preference and 14% is the specific after tax cost of preference. So we get 2.8. And then lastly we will multiply 0.5 with 17, because 50% weightage is of equity. So we get it 8.5. And then make a sum of that. I hope we have summed it correctly. So that becomes 13.4%. So we can say KWC or KO, different symbols are used, is 13.4%. So what is the meaning of this 13.4%? It means overall cost of this 10 lakh rupees funds, 10 lakh rupees capital is 13.4%. However, specific cost of debt is 7% after tax, preference 14%, equity 17%. But sum total is that on the total funds used by the company of 10 lakhs, cost comes out to 13.4%. I hope when we follow these steps, we can easily calculate weighted average cost of capital, whether it may be book value weights, market value weights, or marginal weights. You have to remember the concept. First will be the source of funds. Second will be the amount. If we are using book value, plug in the amount of book value. If we are using market value weights, plug in the market value. And similarly, if we are using marginal weights, plug in the marginal weights, marginal value. Then calculate the proportion as I explained you. Then plug in the after tax cost, and then last column will be proportion multiplied with specific cost. And sum of that, so this is summation WK. W is weightage and K, or you can say summation KW also. Finally, you get answer for the weighted average cost of capital. So that is the way we do it. So let us proceed further with the subsequent example. So now if we take the previous example, what is there? Same example is there. We were given book value of debt. If you see, we were given book value of debt was 3 lakh. Book value of preference was 2 lakh. And book value of equity was 5 lakh. So those were the book value given to us. And now we are given the market value. Market value of debt is 2,70,000. Market value of preference share capital is 2,30,000 and market value of equity is 750. Now if I simply say, in the capital structure there is one more element also, retained earning, which has got a book value of 2 lakh. So we have created a numerical in which we are given the situation like this. Book value of these four sources is 3 lakh, 2 lakh, 5 lakh and 2 lakh respectively. So total book value becomes 12 lakh. and market value of these is 2,70,000, 2,30,000 and 7,50,000. Now remember, debentures are traded in the market, preference shares are traded in the market, but equity is traded in the market. There is no provision for trading of retained earning. Therefore, for the retained earning, we will not have any market value. However, whatever is the market value of equity, that is collective representation of market value of both of these. That is equity and retained earning. It means this 7,50,000, which is the market value of equity, is jointly represented by book value of equity and book value of retained earning. Now what was the book value of equity? 5 lakh. What was the book value of retained earning? 2 lakh. So what we will be doing? This 7,50,000 is to be split into two parts, exactly in the proportion of 5:2. So that will be individual representation of equity and retained earning in the market value of 7,50,000. So let us proceed solving this example. We have to remember the figures. So now what we have these things with us. So debt market value was 2,70,000. Preference market value was 2,30,000. Equity and retained earning, we have to split it like this. Collective market value of equity was 7,50,000. Out of that, 5 proportions go to equity and 2 proportions go to retained earning. So if we work out what is the market value specifically only for the paid up capital, that is equity, 7,50,000 divided by 7 multiplied by 5, we get it 5,35,700. 5,35,700. And remaining amount, retained earning will be how much? 7,50,000 times 2 upon 7. So straight away either we can deduct 5,35,700 from 750. So we get it 2,14,300. And sum total becomes 12,50,000. 12,50,000. So these are the market value weights of each of the source. Now cost of debt was 7%. Preference was, so these are in percentage. Equity, cost of equity was 17%. Now you might be thinking, cost of retained earning is not given. But if I give a recap, cost of retained earning in an implied manner is equal to cost of equity. So in this case, cost of retained earning is 17%. Now we can simply work out. So these are the cost I have written. So this is the cost column. Proportions we can calculate there. So proportion, out of 12,50,000, what is the proportion of debt? So 2,70,000 divided by 12,50,000, we get it 0.216. So how this comes? 270 divided by 1250. Similarly, 230 divided by 1250. So 0.184. Then 535,700 divided by 1250. We get it 0.429. And lastly, since we have to make it equal to 1, so what we can do? By law of exclusion, we can sum up these and deduct it from 1, so that approximation gets care of or is taken care of. So it is 0.171. So you can verify the total, it will add up to 1. So once we have assigned the weights, So proportions are in this column, cost is in this column. Remember, after tax cost we have taken. Now quickly we can create the fifth column, 7 multiplied by 0.216. So when we multiply these two terms, we get 1.512. Then we multiply these two terms. So 14 multiplied by 0.184, we get it 2.576. Then similarly 17 multiplied by 0.429, that is 7.293. And lastly 17 multiplied by 0.171, 2.907. So that makes it the final calculation. $14.288. So overall cost of capital, that is KWC, in this case is 14.288%. So this is the way we will be giving market value weights to calculate overall cost of capital. Now remember, there is no specific market value for retained earning. Whatever market value of equity is given, that has to be split into, or that has to be divided between equity and retained earning exactly in the book value proportions. So that's what we did it for calculating overall cost of capital using market value weights. So we proceed further. So you can see this is the way we did it. We proceed further with the next part. So what we are given in this case? We are again given book value weights example. Now what we have in this case? A firm's existing cost of a specific source is as follows. So that is the specific cost. Now what cost we are given? For debt it is 10% before tax, 14% for preference and 17% for equity. The following is the proposed capital structure. The moment word proposed comes, we are referring to marginal value weights. It means we have entered into the third phase after book value and market value. Now we are going to take into consideration marginal weights. We are going to take into consideration marginal weights. That means company is proposing to issue new debt of rupees 1 lakh, new preference share capital of 3 lakhs and new equity of 6 lakhs, in total 10 lakh rupees. Now definitely the book value of the new sources is given. Now what we need to do? We already have these costs. So first of all, find out KD after tax, that is post tax. So as you remember, it was 10 multiplied with 1 minus tax rate. So we get it 7%. So after tax cost of these sources is given 7%, 14% and 17%. So that is post tax cost. Now still it is existing cost. What is given to us? Flotation cost in case of debt and preference is 2%. Now how to convert this existing cost into the cost of new funds? Because you remember this 7% is for the existing one, as we are given existing specific cost. So we have to convert this existing cost into the specific marginal cost of debt, specific marginal cost of preference and specific marginal cost of equity. Now how do we do that? I'll show you in the next slide. So always remember, if we have to find out KD new, that means specific cost of new debt, simply do it like this: KD old divided by 1 minus flotation cost. So in our case, old KD was 7% and flotation cost of debt is 2%. So how we get the cost of new debt? 7 divided by 0.98. So 7 divided by 0.98, we get it 7.14%. Similarly, cost of preference for the new preference, KP old divided by 1 minus flotation cost. So old KP was 14%, flotation cost is 2%, so we get it 14 divided by 0.98, 14.29%. And finally, for cost of new equity, old equity cost was 17% and flotation cost for equity is given to us 5%. So 17 divided by 0.95, we get it 17.89%. So that is the way we calculate a specific cost for the marginal chunk or marginal capital to be raised. Now situation is simple. We have debt, we have preference, we have equity. All these are the new one. How much funds are coming from that? So marginal value or marginal amount, 1 lakh, 2 lakh and 7 lakh. I hope those were the values. Whatever may be the value, let us assume company is raising 1 lakh by debt, 2 lakh by preference and 7 lakh by equity. Now we will calculate marginal weights. 1 lakh out of 10 lakh gets me 0.10. 2 lakh out of 10 lakh gets me 0.20. And 7 lakh out of 10 lakh, 0.7. If you say out of debt, company is getting 4 lakh. And out of equity, company is getting 6 lakhs. That is, new equity will be 6 lakhs and new debt will be 4 lakhs. Then what will be the marginal weight? 0.4 and 0.6. So only mechanism has to be clear to you. Data does not matter. Now, so these are the new weights. Now we will be using these new costs. 7.14%, 14.29% and 17.89%. And now we will multiply these values with the respective weights and the same mechanism will be there. So idea is simple. Either you can have book value weight, market value weight or marginal weight. Mechanism will remain the same. So let us proceed further. So that's where we discussed about calculation of weighted average cost of capital. So this table we can create and for the purpose of calculation. So always remember, first column will be the source, second column will be the amount. It may be book value, market value or weighted margin or marginal value. Then calculate the proportion. You will be using specific cost. Again to remind you, always use after tax cost. And then last column is multiplication of column third and fourth, and we sum up the last column, that is our overall cost. That is our overall cost. So that is the way we will be calculating marginal cost of capital or overall cost of capital. So in this video, we have learnt about weighted average cost of calculation or calculation of weighted average cost for a company which is using multiple sources of funds. Now, watch out the next two videos also. In that we will be having extensive practice about all the concepts learnt about cost of capital. Till then, keep on revising the formula. Thank you for giving me your time. Thank you.